The U.S. Treasury Department decided to boost the size of its quarterly bond sales, and this once again confirms that the United States is depending on a foreign investment, and Fitch experts were not wrong in their conclusion to lower the country's credit rating for the first time in nearly 30 years. Against this background, investors turned to safe haven assets, including the US dollar. A steep rise in the greenback, driven by risk-off sentiment and the US jobs data, could not but affect oil. The asset lost value, and this comes as a no surprise given the inverse correlation between the US dollar and other instruments. Speaking of oil, it should be noted that this correlation only becomes evident in the event of the sharp and significant movements. Another factor confirming this correlation is data on crude oil inventories from the U.S. Department of Energy. Data showed that U.S. crude stocks sagged by 17 million barrels, beating a draw reported by the American Petroleum Institute. This should have led to a strong rally in oil prices. However, Brent crude oil dipped to the level of $83 per barrel, coming under pressure from a stronger dollar and lingering concerns over energy demand. The latest reports on manufacturing activity in China, the world's largest oil importer, indicated a very fragile recovery. Nevertheless, oil prices are unlikely to edge lower. Most likely, the asset will get stuck in the range of $82 to $85 per barrel. Today, all eyes will be on the Bank of England, and notably the European Central Bank and the US Federal Reserve hinted that the latest interest rate hikes might have been the final ones in the current cycle. If the UK regulator does not follow suit, the pound sterling will likely advance, with the greenback losing value across the board. This, in turn, will back up oil prices. Moreover, taking into account the massive drawdown in the US crude oil reserves, this could bring prices back to the area of $85 per barrel. Almost everything that concerns oil can be applied to gold, which also suffered steep losses. The only difference is that a drop in US crude stocks was not the reason. Even if the Bank of England signals further interest rate increases, gold's upside potential will still remain limited. After all, rising interest rates force investors to flee safe haven assets in favor of government bonds. Thus, the medium-term outlook indicates the metal's gradual slide to $1,900 per troy ounce. Despite upbeat statistics, the ruble lost some ground, and the unemployment rate fell to 3.1% from 3.2%, and retail sales rose to 10% from 9.3%. Both figures beat analysts' forecast. However, the ruble typically responds poorly to macroeconomic indicators from Russia. The balance of payments is of much greater importance. As long as there are fears of a current account deficit, the ruble will probably remain under severe pressure. Nevertheless, in the medium term, its downside potential is extremely low. On the contrary, there are more and more factors contributing to the ruble's gains, and its sluggish weakening can be attributed to inertia. Thus, there is a high likelihood that the Russian currency will soon edge up. And that's all for now. We continue to follow developments in the financial markets. Subscribe to the channel and follow the news with us. And see you soon!